Imagine Wall Street as a thrilling roller coaster. 1 minute you're riding high on tech stocks, and the next, you're plummeting as inflation whispers in the background. But here we are, at the tail end of 2024, where the US stock market is throwing us twists and turns that would make any thrill-seeker buckle up. The AI frenzy, stocks or a bubble waiting to pop. 2024 has been a year dominated by artificial intelligence stocks, driving the market higher even when other sectors lagged behind. Companies like Nvidia and Tesla became the darlings of Wall Street, with valuations soaring to dizzying heights. These stocks weren't just rising, they were rocketing, powered by the promise of AI transforming industries across the board. But as the year progressed, the question on every investor's mind became, is this sustainable, or are we heading toward a burst bubble? According to analysts, while the AI hype has provided impressive short-term gains, these stocks might be overvalued, setting the stage for a potential correction in the near future. The market's infatuation with AI echoes the dot-com bubble of the late 1990s, where exuberance eventually gave way to reality. Inflation, the silent stalker. Inflation has been the unwelcome guest at the 2024 economic party, showing up just when everyone thought the Federal Reserve had things under control. Despite the Fed's aggressive rate hikes in 2023, inflation has remained stubborn, refusing to be tamed easily. The latest readings, though, show that inflation is finally beginning to cool, giving the Fed some breathing room to consider easing interest rates. However, the journey has been anything but smooth. The Fed's preferred inflation measure, core personal consumption expenditures, stayed flat at 2.6% in July, slightly below expectations, but still a far cry from the comfort zone. This delicate balance between taming inflation and sustaining economic growth has kept investors on edge, as any misstep could derail the recovery. Earnings season. The good, the bad, and the ugly. The earnings season in 2024 has been a mixed bag. On one hand, sectors like consumer staples and healthcare posted solid gains, buoyed by robust consumer spending and a resilient economy. These sectors have benefited from consumers shifting their spending to essential goods and services, a trend that has held strong despite economic uncertainties. On the other hand, tech stocks, despite their initial success, started to show signs of fatigue, especially as companies like Meta and Alphabet became overvalued. This uneven performance has made the stock market more of a chess game, where every move needs to be calculated with caution. Investors who bet heavily on high-growth sectors have found themselves on a roller coaster, while those who played it safe in defensive stocks have enjoyed a smoother ride. The Fed's balancing act, rate cuts, and the job market. Federal Reserve Chairman Jerome Powell hinted at potential rate cuts in his recent Jackson Hole speech, but with a caveat. The job market, which showed unexpected strength earlier in the year, has started to show cracks. The unemployment rate climbed to 4.3% in July, its highest since October 2021, raising concerns that the economy might be cooling faster than expected. The Fed now faces the delicate task of cutting rates without spurring further job losses, a tightrope walk that could define the market's direction in the coming months. Powell's comments suggest that the Fed is committed to avoiding a recession, but they also highlight the challenges of managing an economy that is still grappling with the aftershocks of the pandemic and subsequent fiscal policies. Consumer confidence, a beacon of hope. Amidst the market's volatility, consumer confidence surged to its highest level in 6 months by the end of August. This rise in confidence has been a reassuring sign for the economy, suggesting that consumer spending, which makes up about 70% of GDP, could continue to support growth. With wages rising and employment levels still relatively strong, consumers have shown remarkable resilience in the face of inflation and economic uncertainty. But with inflation still lurking and the potential for a job market slowdown, whether this optimism will hold remains to be seen. If consumer confidence begins to waver, it could spell trouble for an economy that has so far defied the odds. Sector winners and losers. Where to put your money? 2024 has shown that not all sectors are created equal. While AI and tech have stolen the spotlight, utilities, consumer staples, and healthcare have quietly delivered steady returns. These sectors have proven to be reliable havens for investors seeking stability amidst the market's turbulence. For investors looking for stability, these sectors might be the safer bet as we head into what could be a more turbulent 2025. On the flip side, sectors like real estate and energy have struggled, weighed down by rising interest rates and a cooling global economy. The divergence between sector performances has underscored the importance of diversification and a well-balanced portfolio. The global picture: U.S. versus the world. While the U.S. stock market has had its share of ups and downs, it's worth noting that it's not the only game in town. Global markets, especially in Europe and Asia, have faced their own challenges, from geopolitical tensions to energy crisis. In Europe, the energy crisis has been exacerbated by conflicts and supply chain disruptions, while in Asia, economic slowdowns in key markets like China have cast a shadow over global growth prospects. This global backdrop has added another layer of complexity for U.S. investors, who must now navigate not just domestic issues, but also the ripple effects of international developments. Investors with global exposure have had to contend with currency fluctuations, political risks, and divergent monetary policies, all of which have made 2024 a year of heightened uncertainty. The tech giant dilemma: to hold or to fold. Big tech has been the backbone of the market's rally, but 2024 has forced investors to reconsider their love affair with these giants. Companies like Apple and Microsoft have seen their valuations reach levels that even the most optimistic analysts struggle to justify. With AI-driven gains potentially running out of steam, the smart money might start rotating out of these high flyers and into more traditional, value-oriented stocks. The question for investors is whether to hold on and hope for continued growth, or to cash out and seek safer, more grounded investments. As the year progresses, the performance of these tech giants will be closely watched as a barometer for the overall market. Looking ahead, September and beyond. September has historically been the weakest month for the stock market, and 2024 is shaping up to follow that trend. With so many variables at play, ranging from Fed policy decisions to earnings revisions, the market could be in for a bumpy ride. Investors would do well to keep a close eye on the Fed's moves and stay nimble, as the rest of 2024 could bring more surprises. The potential for further rate cuts, combined with the ongoing challenges in the global economy, means that volatility is likely to remain high. Those who are prepared for the unexpected may find opportunities in the chaos, but it will take careful planning and a strong stomach to navigate the months ahead. And that's a wrap on today's deep dive into the wild ride that is the 2024 U.S. stock market. If you found this video insightful, or if it helped you navigate the market maze a little better, make sure to smash that like button, and don't forget to subscribe to the channel and hit the notification bell so you never miss an update. Drop a comment below and let us know your thoughts. Are you riding the AI wave, or are you playing it safe in 2024? Thanks for watching, and we'll catch you in the next one.